Hi, I'm Nashlin. In this video, I'm going to talk about calendar spreads for options trading. And one of my friends actually wanted to try options trading using the calendar spread strategy. However, he is not very sure about the risk and reward for the performance of a calendar spread. Now, in this video, I will talk about the at-the-money calendar spread over 30 days expiry and what is the potential market movement and how a calendar spread will perform under neutral, bullish and bearish market movement. I will talk first about the at-the-money calendar spread and potential market movement and the profit and risk regarding this trade. So this is how a calendar spread looks like, right? So it looks like a butterfly as well, and this is a 30 days trade. All right, so let's get started on how to enter such a simulation to backtest our trade. So I'm going to delete this away, and the trade that my friend entered was in SPY. So I'm going to simulate trade and go to a 30 days. He chose a 30 days calendar spread. Alright, so in this calendar spread, chose a at the money calendar spread. So I'm going to right click on this guy, analyze and buy a calendar, which is not shown here, but this is how the trade looks like. However, his spread is over 30 days duration, so his next strike is actually 30 days away, which is on the 29th of September. So I'm going to change this to a 29 September trade over here, and this will be the trade my friend has entered. So he entered at the price of $1.58. So when you enter at $1.58, I'm going to take this only with one trade. Okay, so with only one trade, and he entered at this price. So let us take a look at what is the risk reward profile of this trade. Alright, so currently the market price of SPY is here, 246, around 246, and enter about $1.50. So this is how it looks like. So first thing first, let's make sure that our expiry date is actually set to the same day as the expiry. Alright, so this is how it looks like. Now, how does calendar trade perform over the course of 30 days? So in order to see that, what you can do is actually increase the dates slowly one by one. Alright, and increase, and this is how a calendar spread will look like. The purple line is the T+0 line. You will try to morph into the cyan blue color line. So over the course of 30 days, you will morph until this shape, and after which the calendar, the front expiry date will expire or assign or exercise, and left with the remaining back date, which is left another 30 days down the road. So before it expires, it looks like this. Right now, we understand that this is the range. Of course, we know the very basic break-even point is at these two prices. So the break-even of the calendar is at 247 if the market doesn't go above 247, and if the market doesn't, okay, let me just write it down. So calendar, our risk is actually on 247, sorry, it is at 247 to be sure, 247. Okay, and the lowest range that you will go is about 242 before it starts to make any losses, and that's within the 30 days period. Alright, and let's check out how our market movement will move like. So if you take a look at a quick chart of this SPY, this is where we are, 246. We should look out for is it will goes up to 247, which is 247 is somewhere around here. Let me just try to zoom it in. Okay, 247 is over here, so it doesn't go above 247, or it does not go below 242, which is 242 which is over here. Okay, so this is the range that the calendar will allow the market to move. Alright, so how do we actually understand about our risk for a calendar spread? So now let's take a very simple glance at this SPY market. What I can see is I'm going to take into extreme measures so that when extreme cases really happen, we are prepared for it. Okay, so what are extreme cases? One of them is actually, for example, if you talk about a bullish trend, and it still look like overall is a bullish trend. So the highest bullish trend is that it goes from around 230 around here, 230. It actually went all the way up to 240, and that is within a span of from February 1st or so, around here, early February to March. Okay, end of February to March, and it took 1 month time, and it can rally all the way up to 240. So that's a 10 points movement. That's for bullish trend. So I'm going to take down over here. For a bullish trend, it can go up to 10 points. Alright, and for a bearish trend, and you can see over here, let's take the recent date as a more accurate representation. Not that this always happens, but the nearest is we have 240, it drops down to 230. Again, that is a 10 points movement as well. So what I can safely say is we should consider this trade to be able to move 10 points up and 10 points down within a span of 1 month, which is 30 days. So currently we are over here. Okay, what are the chances of it to go up? Nobody can tell, not even me. So what we're going to do is we're going to take from this point onwards, 246 and 247, plus 10 points up will be 256 to 257, and 10 points down about 356 and 357. So it can actually move these two way up. Alright, so let's take a look over here at our calendar spread. This is our calendar spread, and currently we are over here. Let's take a look at how it performs if it goes up. The moment it goes up to about 248, in fact it goes to 248, within today, this trade will actually make a loss. It will start to hit the break-even point. That's 247. So I'm going to just try to increase the date to see if this break-even point actually goes further way up or not. So you can see that it did. Okay, I'm going to just zoom this in a little bit more. Okay, zoom this in a little bit more. As you can see, as the day goes by, the furthest it can reach is 247. 247.89. So that's close to 2.8 or 248. Okay, I'm going to take it as 247.9. So the furthest you can go to have a break even or not making any loss to your capital is around this point. Alright, 247, and that's about 20 days into trade. Okay, so I'm going to write down to, so my calendar max range is 247.9, okay, 247.9, and bracket, that's 21 days in trade. Alright, and let's take a look at the lowest point over here. Okay, that's about 242. Let me just check if this trade go furthest over there. Alright, so as you can see, this is the furthest over here. You can go 242, roughly 242.11. Alright, so I'm going to take it down as minimum. The market range will go is 242.11. 242.1. Okay, and that is also around 24 days. So you can see, because it started on the 1st of August, and today the trade date is on August 24, so it's around 24 days. So this is actually the risk and reward that I should be looking out for, which means that within the duration of 30 days, I should look out for whether this trade is going to break even at this point or break even at this point. So that is for loss. Usually I would look at the loss first, because that's the most important thing about our risk. And what's my reward? Of course, the reward is what everyone likes to look at. So on today $140, if the price goes all the way up, no, in fact, if the price dropped to 245, I will have made $10 profit. The way to profit from calendar is, as the day goes by, if the market doesn't move, neutral trade, alright, it will go to the maximum of this blue color line, which is $31. Okay, so neutral trade, if the market does not move, I'll profit $31. Okay, and that is approximately, let me just take a calculator, $31 divided by, okay, let me just be sure, okay, so it's actually 158, alright, so 158 of, divided by 158 is equals to this, multiplied by 100, and we will get about 19% of profit. So that is equivalent to 19% of profit. Okay, that's for neutral, and the max you can go. However, if the market drops down to 254, and this is where the peak of the hump is, of course the profit will be much higher and higher if it's nearer to date. Okay, so this is how the calendar will work. So, but most of the time we can't really expect market to stay neutral. Probably it will go up, and maybe it will come down, or maybe it will go down, and it will go back up. So that's the thing that we can hope for. But to be more accurate on the bearish side, we should consider this is only simulating based on delta movement, delta value, which means if the market moves up and move down, we will profit based on this price. However, we should also take note that IV, implied volatility, will have an impact on the calendar trade, in fact on any trades when the market goes down. So when the market goes down, it is quite reasonable to have at least about 2, 3 or even 5% of implied volatility increase. So let's take a quick simulation over here. Alright, so over here is where we can actually adjust our volatility. Let's go to our chart. Alright, and let's go to SPY. Okay, so implied volatility is this. Okay, so you can see that the implied volatility over this area, we are at a very low of 0.1. So when there's a drop in the market, implied volatility goes up. When there's a drop in the market, the implied volatility goes up as well. Over here, market goes down, implied volatility goes up. Market goes down, implied volatility goes up. What we should take note of is it actually goes from 0.1, it can go as high as 0.15, and that's like almost, that could be more than 5%. Okay, and from 0.10 to 0.12, alright, that could also be about 2 to 3% increase in implied volatility. Alright, so let's take that into consideration, that if the implied volatility increased by 5%, alright, and what happened over here? It's okay, so I'm just going to put this here. If the market doesn't move and implied volatility goes up, today alone, I'm still on the first day alone, from $5 of profit, I will jump up to $60. And that's the power of implied volatility or for calendar. Alright, and if the price actually drops to 2 points down, let's say 242, okay, 242. However, we will still be in the profit zone, except we'll be in the downside of the hump. So that's where we should take note of where our maximum profit will be. Now, next is if the market rally up here, the implied volatility actually drops beyond, drops even more. So it's from a high implied volatility to a low implied volatility. And if we have entered our price over here at 0.1, if we were to try to simulate that it goes upward and down and drop in implied volatility, I'm going to just reset this and reset the implied volatility to 0. So if the market rally upward, the implied volatility drops. So I'm going to take it as -1% because the market is at very low implied volatility and there's not much lower it can really go. So I'm going to just take it at -1. And as you can see, if the market goes upwards, implied volatility drops. And if we rally up to 247 just by 1 point, we were making a $15 loss. Alright, so that is something that we should have to consider when the market rally upward for a calendar. And as you can see, we can set aside, in fact, the minimum break-even point for a calendar when it goes downward, if the IV actually spiked by, okay, I'm just realistically, I'm going to increase by 3. Okay, our break-even point is actually about 238. Alright, and let's see where does the date goes furthest. Oh, so in fact today's date is the furthest date, and range reduced as day goes by. Now assume it is a very bearish trend or a very bullish trend. If it goes down by 10 points, let's see what actually happens. So within this duration, if the market goes down to 10 points, which is 236 or 237, I'm going to assume that 236 over here, we're making about $28 loss. So you'll be making a loss of $28. And how many percent is that? Let us calculate. 28 divided by 158. There is approximately 17% loss. Okay, so minus 17%. It goes upwards, and I'm going to take it that I'm going to -1 for implied volatility, and the price go upwards to 246 will be 256 or 257. Okay, I'm going to 256 over here. We will have incurred a $119 of loss. 256, about $119 of loss. Okay, so 119 divided by 158 multiplied by 100 to be sure, it is a 75% loss. Okay, we will be making a 119 and a 75% loss. Okay, so there you are. This is our risk and profit simulation. Of course, the best is if the market stays at about 254, which is where our strike price is. We have the max profit of $74. Max profit of $74. So how would you manage this trade? It is totally up to you on what is your trade plan, what is your risk tolerance in order to get this profit within these 30 days. I hope you have benefited from this video, and if you like this video, please like and share this video. And now it's your turn. Do you do a calendar spread? If you do, what would be your trade plan? What would be your adjustment if the market is going up and you are in a loss? Or what is your cut of profit when the market goes down? Okay, let us know by commenting at the video below. Thank you very much. I'm Nashlin from Safe Investment Options.